स्कूल में जैसे प्रेयर करते हैं, that's how we need preparation.
है प्रार्थना गुरुदेव से, ये स्वर्ग संसार हो, अति उच्चतम जीवन बने, परमार्थमय व्यवहार हो, ना हम रहे अपने लिए, हमको सभी से गर्ज है, गुरुदेव ये आशीष दे, जो सोचने का फर्ज है। हम हो पुजारी तत्व के, गुरुदेव के आदेश के, सच प्रेम के नित नेम के, सधर्म के सत्कर्म के, हो चीढ़ झूठ राह की, अन्याय की अभिमान की, सेवा करन को दास की, परवाह नहीं हो जान की। छोटे न हो हम बुद्धि से, हो विश्वमय से ईशमय, हो राममय और कृष्णमय, जगदेव में जगदीश में, हर इंद्रियों पर ताब कर, हम वीर हो अति वीर हो, उज्ज्वल रहे सर से सदा, निज धर्म रत खंबीर हो, अति शुद्ध हो आचार से, तन मन हमारा सर्वदा, आध्यात्म की शक्ति हमें पल भी नहीं कर दे जुदा, इस अमर आत्मा का हमें हर श्वास भर में गम रहे, गर मौत भी आ गई, सुख दुख हमसे कम रहे।
Good afternoon, everyone. As you all are aware, today we are taking this specific topic of UK taxation, practical overview. Though it may not be in your syllabus today, but today only in the national conference, which is being organized by the Jaipur branch and International Tax Committee of the ICI. So I came to know that till now, apart from the certification course for direct taxes and all that, we have the certification course for international taxation. We have the certification course for UAE taxation, then US taxation, and then institute is now coming with a certification course on UK taxation also. Not only that, in times to come, the institute will be coming with the various other countries taxation certification course like UAE already there, Oman, Muscat, all these countries, whatever taxations are prevailing, the institute will be coming with the various certification course, so that as a chartered accountant, we are not only equipped with our Indian laws, Indian taxation and corporate laws, but also equipped with the various other taxation laws of the various countries. And this also, you can say that enable the phrase that this nothing is certain, but death and taxes are certain. Globally, you will find that income tax is almost there in each country, except a few countries where also now it is realized that income tax has to be there. So in UAE recently, from 2 years back, the corporation tax has come for the various corporates where they are required to pay 9% taxation. And similarly, other countries, the taxation is also there. So we have very prominent faculty with us, Jaikumar Tejwani ji. Last week he was also there, and he is also partner with Kalani and Company. and he is a regular contributory on income tax or international taxation, particularly with the Institute of Chartered Accountants of India. So we have Jay Kumar Tejwani ji, and then we also have today Aman Kumar, who is also practicing in this particular field. So I welcome both of you, sir, and welcome
Thank
to
you.
you again today in this webinar. And now it's over to you, sir, to take the webinar forward.
Thank you, sir. Thank you very much. Good afternoon. And thank you all for joining this beautiful session, very important session on UK taxation, where C. Aman Kumar is going to give us a practical overview. Let me start with why this session exists. On the 15th day of July, just 3 weeks back, 15th day of July of 2026, the India and the United Kingdom, their meeting on the Comprehensive Economic and Trade Agreement came into the force, and also with it, the so that came into the force, and also with it, the double contribution convention on the social security was also implemented. So, with such a wonderful agreements between the two nations, the Indian professionals of late are now getting seconded to the United Kingdoms in much bigger numbers. And even number of our own clients, they are the children, they are studying in UK, they have a house in UK, or some kind of a plan to settle the businesses in UK. And as we all know, India is a much younger society than UK, which is in fact in terms of age, they are nearing 50 as an average age. So this is why the UK taxation suddenly has become very, very important. And our CA Satish Kumar Gupta ji, who is currently the chairman, is taking very good initiatives to bring in all these courses within the ICAI domain. Now, about this session, let's be very clear that this is only an orientation. It is not a technical or a deep dive session. At the end of the session, maybe after 90 minutes or so, not that we'll be qualified to file a UK return, but at least we will know how the UK is, in terms of taxation, is built up. We will know what are the important statutes which govern the UK taxation. We will also know that how better in terms of written law it is equipped. And therefore, just expect a broad orientation, broad understanding. Technicals, if time permits in future, we'll take up. Similarly, one housekeeping note for all that uh, housekeeping note and also your awareness that whatever we are going to discuss is updated as of the 27th July of 2026. That is just a week back. Okay. And like we have the union budgets every year, similarly, UK also have the finance budgets or the finance act which comes up every year, which keeps evolving in terms of tax rates, in terms of some laws, in terms of the systems and the notifications. And before I pass it on to Aman, UK comprises of, and as we all know, they have been the dominant in terms of acquiring a lot of jurisdictions. So currently, four main jurisdictions, in fact, three main jurisdictions on which they have a control includes Scotland, Wales, and also the Northern Ireland. Okay, so this is how the United Kingdoms is made up of. And in this presentation, the entire session is divided into 6 parts or 6 sections. Okay, basically answering or basically putting in place the UK taxation overall. So I would pass it on to Aman now. Aman, please open your video. And about Aman, Aman is a newly qualified but a very enthusiastic chartered accountant. In fact, the background material that we have prepared for UK taxation, he was instrumental. Aman was instrumental in bringing that background material significantly. So therefore, the chance goes to him to present what he has written in the background material. So Aman, welcome, and please take it over from here. Yeah, Aman, over to you. एक चीज और पार्ट वन से पहले फिर मुझे दे देना अभी आप दो स्लाइड्स कर या अमन यू कैन स्टार्ट.
Thank you, Jai sir and Bhupender sir for giving me this opportunity. Today, here we are gathered on the presentation 193rd webinar for professionals. And the topic for today is UK taxation, a practical overview. So before we move forward on the presentation, I would like to give some pointers so that we can use the presentation in the best possible way. I'm sharing my screen now. Let me share my screen. Hi, मेरी screen. Share. Next slide. Is my screen visible?
Yes.
Screen is not visible. Request them to share. So can you please share the screen, sir?
So we are sharing the screen of the presentation. So we are sharing the presentation. You can just continue. And whenever we need to change the screen, please let us know.
So the first point is, please keep the snapshot of this slide handy to you, because going forward in the presentation, we will be referring the abbreviations very frequently. And अगर आपके पास ये रहेगा तो आप refer कर सकते हैं as and when required. Okay. The second one is, at the end of each major section, we will be taking the questions. So if you have any questions, please put up that in the chat box. So
Yes.
now we are starting the first section. Next slide, please.
Yes, next. So
Next
these are
slide.
the actually abbreviations of words.
So here is the agenda of today's meeting. In first part, we will discussing the architecture of Indian UK taxation. So what are the nations in UK, and what are the main statutes, and what are the powers of authorities involved this structure. Second part, we will be discussing the definition of residency in UK, because it is different from what we have residence concept in India. Then next we will discuss the major statutes involved in UK taxation, and then we will learn how to calculate income tax in UK, how to calculate the gross total income in UK, and we will be taking up this with an example ready with us. Next section, we will discussing, since UK is a constitute of 4 countries, so some taxes are with the center and some taxes are devolved to the state, to the regional parliaments. So we will be discussing those taxes as well. And at the last part, we will be discussing the latest change in the India-UK relationship, that is comprehensive economic trade agreement between India and UK. So next slide, please. Over to Jason.
Back. Yes.
About section 1 titled as the architecture. 4 nations, many statutes, and who administers what is a title. And as we all know, as far as India is concerned, we have one Indian Income Tax Act, very comprehensive, broad, number of sections in it, which is supported by the income tax rules. We also have notifications, lot of CBDT circulars, and again the jurisprudence which we refer while analyzing the Income Tax Act. But in UK, it is much more difficult. UK doesn't have one Income Tax Act. And believe me, before 2003, they had no written document. Everything was dependent on the HMRC, His Majesty's Revenue and Customs Department, interpreting the issues. It was all dependent on the judgments which the UK would have passed. But then they realized, and they realized much later in the year of 2003, that they need to have some written document. So Aman is going to cover about the architect and the different laws that govern the UK taxation. And three things that we all need to know. Number one, what are the statutes that we are referring to? Who administers them? And a point that surprised almost all of us is the fact that not all of the UK text is administered by one authority. So these three things are going to be covered under the architecture. Over to you, Aman.
Next slide, please.
So before discussing the UK taxation, let's come to Indian income tax. So to understand Indian income tax, basically we have Income Tax Act and income tax rules, and so CBDT notifications, CBDT circulars, and case laws which are enact major judgments which are coming in time to time. So it is still confusing that we cannot just only read the Income Tax Act and form our opinion, and we cannot rely on only one judgment. We have multiple judgments counter opposite to each other. Sometimes the some high court says something else and the other judgment is coming opposite to that. So it is complex. But if Income Tax Act in India is complex, then on scale of complexity, UK has surpassed in income tax in way more way more than income tax. So as you can see on the screen, there are each act for each head of income. For example, salary head is covered by this 2003 Act. Trading, property, and saving income is covered by this 2005 Act. Rates and allowances are referred under separate act, which is in 2007. Then corporate taxes are covered under two separate acts, 2009 and 2010. So even for a simple corporates, we cannot rely on single act. We have to refer both acts in sync. Capital gains are again covered under separate act, and similarly indirect taxes also covered under different act. So this, and believe me, this list is not the exhaustive list. Apart from this, there are also many acts which cover different aspects of income tax, such as transfer pricing, assessments, appeals. These all are covered under different acts for their administration. So coming to the next slide, we will be discussing these things in detail. So in this slide, we will discussing what are the authorities and what are their powers devolved to them. So as we discussed in the first slide, that UK consists of four countries, Scotland, Wales, and England and Northern Ireland. So they have a uh, central and regional structure of central and regional structure of politics, wherein UK Parliament is the central body, and there are two regional parliaments. One is Scottish Parliament, another is Wales Parliament. So UK Parliament is majorly responsible for enacting the national taxes, and the Scottish Parliament and Wales Parliament are responsible for their regional taxes, which are land and building taxes and landfill taxes. So HMRC, UK Parliament is the main body जो acts बनाती है. Then HM Treasury is their finance ministry which governs the policy and presents the annual budget. Then HMRC is the one who administers all taxes and policies. So even if income tax in Scotland is paid by Scottish rates, but still HMRC is the one responsible for collecting all income taxes all over the UK, and it administers the income tax directly. And not only income tax, HMRC is responsible for indirect taxes also. Apart from that, HMRC is responsible for their TDS structure, which is known as PAYE, which stands for Pay as you earn. So HMRC is responsible for that also. Coming to the next slide, we will see which taxes are covered by these HMRC. So there are two types of taxes. First is direct taxes, which covers income tax, corporate tax, and capital gains, and inherit tax. The another is indirect tax. And as you know, in India, there are two separate departments for each taxes. Direct taxes are covered by CBDT, whereas indirect taxes are covered by CBIC. But in HMRC, there is only one body which governs both direct as well as indirect taxes. So this is also a new concept because before 2005, HMRC was not responsible for both taxes. Before that, Inland Revenue was responsible for direct taxes, and HM Customs and Excise was responsible for indirect taxes. Now, what is HMRC? HMRC stands for His Majesty's Revenue and Customs. And since King Charles came into the power, therefore it is now his. Before that, it was Her Majesty's Revenue and Customs. Coming to next slide, we will see the acts which are responsible for that. So let's take example and understand how different acts are covering different types of income. For example, an Indian group has UK operations and over 1 year it generates the receipts and transaction as given below. For each, let us identify the governing statute and the authority that administers it. So there are 6 types of transactions here, and we will identify which taxes are covered under which act and who administers it. For an instant, it may seem a very simple transaction, but believe me, the different acts will be referred for each type of transaction. For example, salary paid to a UK-based employee. It is a salary income and it is covered under 2003 Act and it is administered by HMRC. Trading profit of UK subsidiary. UK subsidiary, since it is a company, so it will be covered by CTA 2009 and CTA 2010. It is also administered by HMRC. Rent from a let flat in Manchester. It is a property income and it is covered by 2005 Act. And the rates for all of the incomes is decided by 2007. The another is gain on sale of shares in subsidiary. It is transfer of capital assets. So it is covered by TCGA Act. For abbreviations, you can refer the slide uh, presented in the start of meeting. And TGCA stands for transfer of capital gain assets. It is also administered by HMRC. VAT and UK supplies are indirect taxes, and it is governing legislation is WATA 1994 and administered by again HMRC. Since there is no another body for indirect taxes, so everything direct and indirect taxes are governed by HMRC. Now let's come to this transaction: purchase of an office in Glasgow. So Glasgow is situated in Scotland, and as you know, there are separate parliaments for both. So, purchase and sale of properties are, which we will be discussing in little more detail in next slides, upcoming slides. So, not upcoming sections, another section. Please come to the previous slide.
Previous slide.
Um, that example slide. Wait.
This one, yes.
Yeah. Okay. So purchase of property is a separate transaction and it will be governed by Land and Building Tax Scotland 2013. And since it is a regional tax, it will be governed by Revenue Scotland. So as you can see, these 6 transactions are very simple. And in India, we don't have to refer every act for this. But still, as you can see, UK has a separate act for each transaction. And also a single transaction has 2 separate bodies for it. Like HMRC covers this salary paid to WATA and purchase of property is covered by Revenue Scotland. Let's come to the next section.
Uh, Thank you, Aman. I think you covered it very nicely. So, what have we actually learned from this? That number one, 3 things actually. What he mentioned. Number one, there is no UK tax code. It is again divided into multiple acts. Second, HMRC, His Highness, His Majesty, the Revenue and Custom Department administers all the taxes, be it direct or indirect, except for the jurisdiction of Scotland, where they have some limited rights, which we are going to discuss shortly. And it is doing so because in 2005, the HMRC, the direct and indirect taxes both came under the jurisdiction of HMRC. Otherwise, there were two different authorities. And third, what he mentioned was that except for Scotland, even Wales to a larger extent depends on the UK. There are certain taxes which are devolved on the Scotland, but still collection is controlled and managed by HMRC. Okay, so this is what we just read in the architect section. And before passing it on to Aman for dealing with the most important part, which is residency. Like in India, we have a resident and ordinary resident and non-resident. Of course, we have a concept like resident but not ordinary. So, but not ordinary resident concept is not there in UK, but otherwise the resident and the non-resident concept is there. And in UK practice, as far as Section 2 goes, resident is not a preliminary matter. Okay, residence is actually the work. It determines whether the client or the person is taxed on worldwide income or not, and this is important. Unlike India, residence is very, very important in UK, and they believe, the UK people believe, that holding a British passport may make them UK taxable as a citizen, but not necessarily that they are resident for the purposes of taxes. So all these things are now going to be get covered. We are going to cover it under residence. And I'm going to pass it on to Aman again. Aman, if you could talk more about the first question in any and every UK engagement. Yeah.
So in coming slides, we will discuss the concept of residence in more detail. So before discussing the concept of residence, let us first understand that residency is not equal to citizenship. To be a citizen of a country, you have to fulfill certain criteria like birth rights, number of days for specific number of years. Either your grandparents or parents are staying in that country. So citizenship, a birthright concept, or it is a separate concept. But residency is decided on the basis of number of days stayed in India or in any country. For example, if I am an Indian citizen and I move to UK for employment purpose, then I will be staying in 2 3 upcoming years in UK. So in those 2 3 years, I will not be an Indian resident because I haven't stayed a single day in India, but still I will be a citizen. Similarly, if a UK citizen is coming to India for employment and he's staying in India for 2 3 years, then in those 2 3 years he will be a resident, but not an Indian citizen. So to sum up this, we can say that a person may be a citizen and a resident. A person may be a citizen but not a resident. A person may be a resident but not a citizen. So these two concepts are different. And for tax matter, the concept relevant is residence, and citizenship is of no relevance. Okay. So citizens residency was introduced in UK by Finance Act 2013, and before that the residency concept was majorly dependent on HMRC guidance and case laws and judgments. So there was no written document for the concept of residency. And in 2013, the UK authorities came up with a very detailed concept of residency, and in for that matter they had certain tests to satisfy, and those tests are conclusive and we can decide on the basis that someone is resident or not. Then other point is residency is not a one-time process. So if someone is resident this year, it does not imply that he will be resident for lifelong. Residency is to be determined in each tax year and for every tax year for every individual. for the since in this presentation our main focus is on taxation of individuals, so company residency is not discussed in detail. And for individual, the residency is decided on the basis of number of days stay, and for companies it is decided on the basis of central management and control. In next slide we will be discussing the concept and test applicable in UK. So in UK tax law, the statutory residence test is discussed in Schedule 45 of Finance Act 2013, and majorly there are three tests. Out of them, two are automatic test, and the third one is sufficient ties test. So what are automatic tests? So automatic tests, both overseas test and UK test, have certain criterias, and if you fall in any one of the criteria, you will be either a automatic resident or a automatic non-resident. Once you satisfy any one criteria, you will be classified as resident or non-resident. There is no need to check whether sufficient ties test met or not. So in next slide, we will discuss each test in detail with help of example. First is automatic UK resident tax. So the total automatic UK resident tax are four. Out of them, two are detailed discussed here. First is number of days stayed in UK. So a person has to stay in UK for 183 days or more to become an automatic UK resident. Another one is a person has a UK home meeting specified condition in the Act. And let's take an example. Mr. A spends 190 days in UK in tax year 26-27. So if you can see that the stay is obviously more than 183, so he is an automatic UK resident. Whether we have to check the sufficient ties test, the answer is no. So the another test is automatic non-resident test. Again, these are in number 5, and I have discussed here only 2. So first one is a person was previously non-resident, and his number of days in UK is less than 46, and a person has stayed in UK for less than 16 days, and his number of days is uh, less than 16, and he was previously a resident. For example, Miss B spends 40 days in UK and not resident in last 3 years. So as you can see, the number of days is less than 46, and she was a previously non-resident, so she satisfied the second criteria, and therefore she is automatically a non-UK resident. So do we have to check whether she satisfy a UK resident test or not? No, since she is automatic non-resident, we do not have to check other conditions. And you can also see that these two tests are mutually exclusive. One can only satisfy any one condition and not both the test. So one person cannot satisfy the automatic UK test or automatic non-UK test. So automatic test and automatic non-UK test are conclusive. And if we cannot come to a conclusive opinion on the residence, then we will move forward on the sufficient ties test, which are more detailed and not discussed currently, because majorly all the questions of residence are solved with these two tests only. So let's come to next slide. So why the answer matters ki if someone is a resident or not? Because in UK the concept of income tax is levied on residence only. In India, like we have a concept of RNOR and ROR. There is no such concept in UK. So if you are a UK resident, then whole the worldwide income will be taxable in UK. And if you are a non-UK resident, whole of your income will be only on UK source income will be taxable in UK. So it is very important for us to determine the residency concept before computing the income and other things. So it is a primary and very important step in the computation and not a mere formality for that. Let's come to next slide. So let us take an example that to decide why the concept of residence is important. So in this example, Mr. Rao, an Indian citizen, works in UK during 26-27, and he also lets a property in Pune and sold some Indian shares at a gain. So whether he is a UK resident or non-UK resident will decide the taxability of these three items. So first take the salary income. Since salary for duties were performed in UK, so it is a UK source income. And if he is a UK resident, it will be taxable in UK. If he is not a UK resident, still since it is a UK source income, will be taxable in UK only. Rent from property in Pune. Rent from property in Pune is a Indian source income, but since he is a UK resident, it will be taxable in UK. And gains on Indian listed shares, it is also India source income, but still, if he is a UK resident, it will be taxable in UK. Coming to the other option, if he is a non-UK resident, his income, only salary source income, which is a UK source income, will be taxable in UK, and other foreign income such as rent from Pune property and gain on shares will be taxable in India. Also, if you can see, if someone is a UK resident, then his whole income will be taxable in UK due to residency, and the other two income, property and shares income, will be taxable in India also. So there is double taxation, but due to the in the DTAA between India and UK, the taxes paid in India on the Pune property and shares will get the credit in foreign for taxes paid in India. So there is no double taxes levied. Due tax credit will be given to UK, given in UK. So the main point to discuss this slide is due to residency. Coming to back previous slide. Due to the residency, two out of three streams were taxable in UK, and since residency was not in UK, the two streams were taxable in UK. So determining residency is therefore very much of importance. Let's come to next slide. So far, we discussed that the taxes are levied on the basis of residency. But in this slide, we will be discussing the exception to that rule. So this rule is for long-term non-residents. So before discussing this slide, let's discuss the concept of residence and domicile. We have already discussed the concept of residence, and the domicile is that someone has a permanent home in UK or in any country, or someone is permanently staying in UK. Okay. So what is this 4-year FIG scheme? FIG stands for Foreign Income and Gains Regime. So what is the exception? So it can be best understood by the help of an example. Let's take the example. Mr. C becomes a UK resident after 10 consecutive years of non-residence, and he has a foreign income of 100,000 euros. So due to this 4-year FIG regime, for first 4 years, these foreign incomes will want to be taxable in UK, and it will be taxable in the foreign country. And from year 5 onwards, the this 100,000 income will be taxable. So this only one scheme, 4-year FIG regime, is the exception to residence concept. And with the help of this example, we covered fairly the most part of residence. Let's come to the next slide.
Covered, Aman. So how do we conclude this slide? Number one, let's start with the foreign income and gains, FIG. In India, we have a similar concept, which is 9 out of the 10 years. So practically for first 2 years, the overseas income is not subject to tax in India because of the provisions in the Income Tax Act. Similar scheme is there in UK, but instead of two, they have a fixed period of 4 years. That for first 4 years, the income which is earned abroad will not be taxed in India. And of course, they have the same condition as we have in India, that you should be a non-resident for 10 consecutive years. And again, the residency, as very nicely described by Aman, is governed by the statutory residence tax test, which is given in section 21A of the relevant act. Schedule is 45, and this was introduced by the Finance Act of 2013 in UK. The three tests which he mentioned was, one is the fixed tax, wherein if you are in UK for a period exceeding 183 days, you become a resident. Second test was if you are there for a period less than 183 days, then you become a non-resident. Third test, which I think he briefly mentioned, was the sufficient ties test. In case there is a situation where, because of some reasons, you are resident of UK as well as another country. So under that test, there are certain parameters which are to be considered, like do you have a permanent home in UK? Where are your economic interests? Where are you actually employed? Where are your families? So under third test, which is rarely used because number of days generally determined, uh, that test also is applied. And one very, very important thing, which again he mentioned, was that something great happened effective 1st April of 2025 when this concept of domicile or the concept of the abolition of the remittance basis was abolished. So now the concept is very simple that the first 4 years, the foreign income will be not taxable in India. And this happened only last year. Okay. And then after, and of course, the condition is that you should be a non resident for 10 consecutive years. Then only you will get this 4 year benefit. And one housekeeping again, which is very, very important, that the entire thing, what he just discussed about the residency concept actually happened effective April of 2025. And there are a number of changes which have happened, which he has, of course, consolidated, Aman, effective April of 2026. And as our law is updated till 27th July, and if you find something new in the newspaper today, it may not be covered because every day it is evolving. The country which ruled India is now getting inspired by the way India is developing. So this is what it is. So thank you, Aman. I think you did it very nicely. Let's move to the other part now.
So let's discuss this section. And it now so far we discussed the administration, which authorities are involved in the UK taxes, and which authorities have what powers. We have discussed the definition of residency. In this section, we will be discussing the major statutes involved in the UK tax structure. So starting में भी हमने डिस्कस किया था कि there is a separate act for each head of income. Like in India, we have separate chapters, they have separate acts. So the employment income, to go easy on the presentation, I will be mentioning only the year of enactment, and I hope you guys can take this in consideration. So the employment and salary income is covered by 2003 Act. Trading and property, saving income, and all other income of an individual apart from salary and capital gain is covered by 2005 Act. So this covers every aspect of individual income other than salary and capital gains. So if dividend income, it is also covered is this act. Property income is also covered this act. Dividend, savings, interest, every other income is covered under this 2005 Act apart from salary and capital gains which have their own enactments. So हमने सारे incomes consolidate कर लिए individuals के. Then after computing the gross total income, we have to refer the rates and allowances and reliefs available to individuals, and for that matter we will be referring ITA 2007. So ITA 2007 tells us about the rates and allowances applicable on the individual taxes and corporate taxes also. So corporate profits, corporate tax is covered by two acts, two separate acts, and both the acts have to be read in sync. We cannot read any act in isolation. And to determine corporate profits and the distribution of losses and set off of losses, we have to read CTA 2010. So both acts are very important and to be read in sync. Capital gain, this Act 1992 is common for calculation of capital gains for corporates as well as for individuals also. And this covers the transfer of capital gains shares, immovable properties, and other capital assets. The definition is also covered under this act, and gains tax rate for capital gains is also covered under this act. Inheritance tax is levied on the transfer of estate from one person to another person. There are exempt transfer, there are taxable transfer, and it is detailed covered in detail in this act. There is no concept of inheritance in India, but inheritance tax is still levied in UK. Value added tax is indirect tax, just like GST. It is a levied on goods, supply of goods and services in UK. And in this slide, we are covering majorly direct taxes. So in upcoming slides, we will discuss in brief in each head of these acts.
So, Aman, I have few questions here. You are able to hear me?
Yes, sir.
Yeah. So my query is that since each of the head is being dealt by a different statute in UK, so how the provisions related to the set off of the incomes, like in India we have the setting off of incomes from business and profession with the other incomes, interchange, interhead setting off is also allowed. So whether such provisions are there in the UK law also, or uh, suppose there is a loss in the business income because corporate tax must be dealing with the business income and capital gain is being dealt by this. So there are possibilities that these incomes are not set off with each other as it is there in the Indian law. Yeah,
Yeah,
exactly.
exactly. We have the same thing in UK as well. For corporate, they are governed by the CTA Act of 2009, and the benefits, reliefs, set-offs, they are given by the Act of 2010, 2010. Same for individuals as well. So we have a 2005 Act. It also talks about the set-off of losses. So exactly on the lines of India, they have the similar acts for setting off the capital losses, for setting off the business losses, and for corporate as well, we have two acts. The purpose was 2009 was more about defining the incomes. 2010 brought in the reliefs, the set-offs, and the rates. So, Bhupinderji, you're right. Exactly the same we have in UK as well.
But interhead setups are not allowed. This is set up within
No, no,
the.
they are allowed. They are allowed. They are allowed. They are
Okay.
allowed. But individuals generally, uh, because they could have losses under gains and business. So they're allowed to only set off against those. But corporates can set it off against other heads as well.
And provisions like clubbing of income are the provisions are there, like we
Clubbing
have.
currently are not that visible. But yes, if there is a child below 12 years of age, then the parent, which is earning the highest, the income will get clubbed in their hands.
Okay, got it. Continue. Aman, you can continue now.
So we will come to this slide at the end of this section. Let's move to the another slide. So first of all, we are covering is 2003 Act.
Yeah, so I think Aman has escaped the previous slide, which he's going to cover later. So now
Yes,
let's talk
yes.
about let's talk about the personal income. The today's session is more. Uh, in fact, we are going to talk more about individuals than corporate today. So regarding the personal incomes, which are covered under 2003 and 2005. 2003 is the Employment and Pension Act, and 2005 is Trading and Other Income Act, IT's income tax. So 2003, which is Employment, Pension, and Social Security, it basically includes everything and anything that we cover in India. That is salary, wages, etc., which Aman is going to talk about. But important here is that the bifurcation is very, very stringently followed in UK. In India, at times, we could include certain things under salary. Okay, RSU is not defined, let's include it under salary. If there is any special payment on account of, say, death, let's include it under salary. But UK laws very clearly why they are different. Of course, we have given few examples, but then they are very detailed as to what the salary income is and what is the trading and other income. So that is how 2003 and 2005 are devised. So, Aman, maybe you can take us through.
So 2003 Act majorly covers the salary income. I mean, not majorly, it only covers the salary heads of income. So it covers the salary during the employment incomes also and post-employment incomes also, such as pension and other benefits on the termination. It covers also perquisites, monetary perquisites, non-monetary perquisites, allowances, bonus, and the apart from salary, it covers the tedious tedious system of UK. So it calls PAYE. It stands for pay as you earn. So TDS system is covered by this act, and HMRC collects the TDS under this framework, and it is governed by Part 11 of the act. So this was all about 2003 act. It covers the salary head. So whatever we have studied here in salary head is all covered by this act. Even ESOPs, because even though it is shares and securities, but still at the time of acquisition, it is governed under it is covered under disguised remuneration arrangements. Another act is 2005 Act. So for individual taxes, apart from salary, to sum up, we can say that every other heads of income is covered by ITOI other than salary and capital gains. So what it covers is trading income, trading from profession, business, vocation, speculative, non-speculative. It covers the property income, residential property and commercial property. It covers savings income, investment income, interest, dividend. Whatever we have left apart from salary and capital gains is covered under this act. And rates to for both incomes we have to refer 2007. Let's come to next slide. Let us discuss the corporate incomes in brief. So there are two acts, 2009 and 2010. So 2009 and 2010, both of act have their references in their definition. 2009 act says that we have to refer 2009 and 2010. 2010 says the same thing about 2009 act. So what is covered under 2009 is basically how to calculate business income. Which allowances will be added in income, which will be deducted from incomes. So computing the business income is governed under CTA 2009. Trading income, loans and relationship, derivative income, intangible assets, fixed assets, property income, and foreign exchange loss. So computation of income is governed by this 2009 Act. Once we have decided the profits, now we have to decide which profits losses can be set off and carry forward. For example, intra-group transfer of losses or distributions and dividends, closure of companies, charitable donations, and anti-avoidance framework for corporates is discussed in 2009. So both the acts have to be read in sync, and without one act cannot be read in isolation to determine corporate profits. Coming in next slide, we will discuss more acts. So these acts are also part of individual taxation, but we have not discussed in detail. First is TGCA 1992. It is already explained. It covers the gains from transfer of shares and other capital assets, gift, holdover reliefs, and corporate gains are also from capital gains are covered under this act. So TGCA is common for both corporates as well as individuals. Another act is Inheritance Act. It is levied on the death and transfer of property from one person to another person. Earlier, the inheritance tax was covered as per remittance, but now it is also covered under the scheme of residency. And there is concept of long-term residence. So inheritance tax is levied on only long-term residence. So to be a long-term resident, you have to be at least residents in 10 years out of previous 20 years. Another act is 1994 Act. It covers the indirect taxes on supply of goods and services. So now we have discussed, let's come to the first slide which we skipped earlier.
Previous,
Yes. Uh, can you please come to previous slides और एक और previous? हाँ, एक और एक. Okay. So this slide is to sum up everything we have discussed so far in this section. So is we have different acts for individuals. ITPA 2003, ITPA 2005, 2005. So computation of income is responsibility of these two acts. So to compute the income, we have to refer these two acts along with Capital Gains Act. Once we decided the total income, we have to refer ITA 2007 for rates, allowances, and reliefs. Then what are the bands of taxes and what are allowances allowed to individuals, what are reliefs. Then we calculate the tax liability. So this slide is the sum of discussions so far, and same format is applied in corporates also. So to calculate the corporate profit, we refer 2009, and to set up the losses and reliefs, we refer 2010. And TGC is common for both individuals as well as companies. And let's come to the next slide so that we can understand this in through examples. These acts are जो मैंने शुरू में बताया था कि the list I have shown is not a exhaustive list, it is just a illustrative list. So these acts are also part of income tax statute in UK. You can see that returns assessment inquiries have different income tax act. International taxes matters are governed by different act. Then there are finance act prescribing rates and amendments. Then there are tribunal informants act which covers the appeals and tax disputes. Then there are VAT regulation act which is for indirect taxes, and there are Scotland Act for Scotland taxes. Okay, so let's come to next slide. Now let us understand the whole ID acts discussed so far. So there is one Miss Kapoor is a UK resident, and in 2026-27 she received the following income, and we will be identifying under which head each income is falling. So I will, participants are requested to answer in the chat box if they can identify. So first one is salary and cash bonus. So it is a salary head income. So it will fall under 2003 Act, and rates are decided by 2007 Act. Discounts on shares acquired from her employer. It is transfer of shares, but for employee, it is a salary head income. So it will also be covered by 2003 Act, and rates are decided by 2007. Growth in those values. So at the time of acquisition, the shares will be taxable under head salary, but once they are transferred to another person, the taxability will arise under capital gains head. Rent from UK flat. It is a property income, and apart from salary and capital gain, everything is covered by 2005 Act. Paying interest, dividend interest, everything else apart from salary and capital gain is covered by 2005 Act. And you can see that rates for all income apart from capital gain is covered by 2007 Act. Okay, this was all about the taxes covered. Now we are moving for the next section.
Thank you, Aman. So the keynotes from what we just discussed, and we need not be remembering the tables, etc. This is a just an introductory session that what actually comprises the UK taxation. So the different incomes, different tax, and the best way to remember is 2003, 2005, 2007, and 2009. 2003 is employment and pension income. 2005 is trading and other incomes. 2007 is the rate. It gives us the rates. And this is how the remembrance happens. And when we were asked to prepare a background material, and Mr. Gupta said कि भैया 31 जुलाई तक बना के देना है, तो हमने उनको पॉइंट आउट किया कि सर वो एक एक्ट नहीं है कि एक इनकम टैक्स एक्ट को कि आप पढ़ के दे दो. देयर आर मल्टीपल मल्टी पेज एक्ट्स. सो this opens a big arena for the Indian chartered accountants to practice. If you go to UK, you will only find the specialized persons. Maybe somebody is exercising or practicing the employment. Maybe some CAs practicing just the trading income. There are few very specialized firms who are doing only the corporate tax. और कई firms ऐसी हैं जो सिर्फ आपको tax rate बताती हैं. Then there are firms which will tell you under Corporate Tax Act of 2010 that okay, these are the intra-group losses you can carry or you can set off. There are the charitable donations, the deductions you get, the reliefs जैसे हमारे यहाँ 80I है, 80G है. So everything is governed by separate act and the practice is again divided likewise. So off late, because of these changes and Indians being already, under one act, we are doing so much. The practice has suddenly opened in last few years. Okay, so this was the object of what Aman just discussed. And now let's move to some practical aspect as well. This was more because architect, then we talked about residence, and then we talked about different acts under which the income is taxable. Now let's go to practice. Let's sort out some numbers. Let's see how those numbers translate into the taxes. And before Aman begins, so Scotland, one of the very major jurisdictions falling, and it is just, in terms of area. Of course, England is bigger, but Scotland is not that small. And they have been struggling for independence for a very, very long time. But the independence there doesn't happen by fight. They have no separate army. It is by referendums, which happen almost every 10 years. So in case the referendum says that 60% people wants independence, they will be made independent. But currently it is 25-30%. So, but still they have been given certain rights to tax, which Aman is going to talk about. So income tax in practice, the three-step computation and the Scotland's divergence. Over to you, Aman.
Next.
So first of all, the first step is to identify total incomes, which we have discussed in detail up to now. The employment income covers 2003 again, then this similar way. So एक बार हमने incomes decide कर लिए कि according to the relevant definition of the act, कि which income is falling under which head and which statute, we will compute the total income. We will club all the acts and compute the total income. Then we will refer another act 2007 for allowances. Allowances are of different kinds. One is a flat allowance, another is allowance income wise, such as there is a dividend based allowance, there is allowance on savings income, and currently the personal allowance, which is a flat allowance, is 12,570 euros, and it is fixed for upcoming 4 years. Also to note the point is this allowance is not allowed if your income is above 1 lakh euros. So we have decided the total income, and we have included the allowances also. Now next step is to calculate the taxes based on the bands and rates available to us. And to decide the tax rates, we have two types of bands. First is for England, Wales, and Northern Ireland. There are three bands, and for Scotland people, there are six bands. We will be discussing then this in detail in upcoming slides. So let's move to the next slide. Another next slide. So what is the importance of Scotland? And as sir discussed that Scotland is fighting for its independence for a very long year. So as a result of that independence fight, in 2012, there come a separate Scotland Act, and it empowered the Scotland Parliament to make some local rules for their legislation, their administration. And इसी सीरीज में उनके पार्लियामेंट को राइट्स मिले कि दे कैन टैक्स देयर पीपल्स on different rates other than national rates. But the 2012 amendments were very limited. So it was a flat allowance. Like if UK people are taxed at the rate of 40%, so the max Scotland people can do is they can be taxed at 30%. So there was no autonomy to decide the bands, to decide different rates. So it was a very limited autonomy, and therefore the next amendment came in 2016, and it allowed the Scotland people to determine their own bands. So currently, UK people are taxed at three bands, and the highest rate there is 40%. But Scotland peoples have six bands, and the highest rate there is 42%. And these, just to note that these two acts are not a finance act or not a tax act. These are constitutional amendments, and it empowered the Scotland Parliament to make their own acts and their own taxes. So coming to the next slide, we will discuss how these acts are. Okay. So to sum up the whole discussion so far, Scotland Parliament made their act and determined their taxes, but those taxes are limited to employment income, property income, and pension income. Those rates are not applicable on savings and dividend income. Everything else is taxed at the rate of Scotland rate, but there are two exceptions, and that is saving income and dividend income. So for taxpayer in England, Wales, and Northern Ireland, we will say England taxpayer for ease, and the Scottish taxpayer. So employment income is taxed at UK rates for all England taxpayers, and for Scottish taxpayer, everything is taxed at Scottish rates, and savings and dividend income is taxed at UK rates. It is a little bit confusing at this stage, but once we are through with an example, it will be very crystal clear. Let's come to the next slide. So here is a simple example. There is one UK taxpayer and there is one Scotland taxpayer. They both have a salary income of 60,000 euros, and the personal allowance is 1257, 12,570 for same for both. And the taxable income came is 47,430, 47,430. So the income is same, allowances are also same, net taxable income is also same. But once we start the computation, we can see that first 37,000 were taxed at the rate 20% for UK taxpayers, and another were taxed at 40%. These are three rates. Other rates is zero rate, but it is not falling here. So the total tax payable by UK taxpayer is 11,000 approx. But for the same income, for the same taxable income, for Scottish taxpayer, there are rates are different. The first rate is 19% and 20%, and so on. The highest rate is 42%, which is more than UK taxpayer, and that's why the tax came at 13,000 approx. So for the same income, UK taxpayer are paying more and Scottish taxpayer are paying less, and the difference is 17,571. So it was a very simple example, only one source income and flat deductions. Now let's come to a very little detailed example. Coming to the next slide. Okay. So in this example, we are having different source of income to decide to understand better how tax rates are applicable and how Scotland Act plays a different role here. So Miss Fraser is a Scottish taxpayer. For 26 20, 27, she has employment income 60,000, bank interest 1,200, UK dividend 2,000, and personal allowance was 12,570, which is fixed against the salary head. So the employment income comes to 47,430, and bank interest, which is 1,200, comes to at UK rate because it is saving income, and the UK rates allows 500 allowance flat on saving income. So the taxable income is 700, and the point to note is this allowance is not due to Scottish tax rate. It is due to UK tax rate. Similarly, dividend income is 2,000. It will be also taxable at UK tax rates, and UK tax rates provide 500 flat allowance on dividend income, and the taxable dividend income is 1,500. So for the same person, there are three different types of income and different tax are applicable here. First is Scottish rates, then UK rates. Allowances are also different. First is flat personal allowance, and the another is personal saving allowance, personal dividend allowance. So Miss Fraser pays a Scottish tax rate of 42% on salary income, but pays only 40% tax rate on interest income because these are applicable on UK taxes. I hope this example help you to understand the difference between UK taxpayer and Scotland taxpayer. And now coming to the slide we skipped earlier, previous slide, पीछे 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 नहीं नहीं हाँ जी. So this is the summary of tax compliances cycle for UK. The individual tax year starts from 6th April to 5th April, and corporate tax year start from 1st April to 31st April. These are the major dates for filing tax returns and payment of taxes. The important thing to note is in India we have a system of filing tax rate and payment of taxes are due on same rate. But for companies in UK, the filing return due date is 12 months from the end of accounting period, that is 31st March of next year. But payment of tax has to be made before December of next year. So this is the key difference between India tax law or UK tax law. The payment and return dates are different, and payment date lies 3 months before the return date. So this is all about this section, and we will be moving to the next section.
Interesting thing that we observed that there is a standard allowance of 12,000 something euros, which equates to approximately INR 13 lakhs. And India is not far behind. We are also having no income tax up to, subject to certain conditions, up to 12 lakhs. So this is how India is now grown up and quite matching with them. And then they gave certain 500 euros on dividend and interest. Again, we are not far behind on capital gains. Long term, we are giving 125,000. So 500 becomes approximately 55,000. So India is catching up very fast. Scotland, of course, when we visited Scotland, very beautiful, very good country, but everybody is desiring the independence. हम एक बार घूमने गए, somebody took us, that bus we hired. So the kind of patriotism we found relating to Scottish people, they wanted the independence. वो कह रहे थे हमारा अपना देश कब होगा? When are we going to decide? कुछ कुछ हमें उन्होंने राइट्स दे दिए कि आप ये करो वो मत करो, but still UK administers us very strongly and tightly. तो ये सब जो अभी हमने बात की ये वहीं पर है. But just to sum up what Aman talked, that Scottish rates are little higher because for them they consider themselves as still a progressive state or a developing country. So in any developing country, including India, the tax rates generally are higher than the tax rates in the developed countries. And second, the major challenge is that everything is controlled and administered by the HMRC of UK. जिसकी वजह से जो इनका शेयर है इनके पॉपुलेशन इनके रिसोर्सेज के अकॉर्डिंग इनके पास आता है. Okay. And another very important point that we just noted that the tax year for the corporate, of course, is 1st April to 31st March. But they have to deposit their entire tax liability. That is, their tax computation, audit, tax audits, etc., must be finished off by 31st December, and the entire taxes to be paid by 31st December. In case they pay the taxes late, there are certain fines and penalties. But then they get 3 months' time to file the tax return. Whereas in India, we get 1 month's time after uploading all the tax audit, TP, etc., to file the tax return. And for individuals, they have very, dates starting from 6th April, which according to them is their date of on. जैसे हमारे यहाँ कई पवित्र दिवस होते हैं. For them, 6th April is what the date is, which ends on 5th April of next year. And again, individuals have quite a flexibility in filing the tax return within 9 months. So otherwise, everything else remains same. And now I would be requesting Aman to talk about the land and building transaction tax, which is so special in Scotland and which gets covered under Part 5, the devolved taxes. Though it is a short part but necessary for all of us to understand that some taxes UK might have devolved on Scotland and how best the Scotland is using the opportunity that they have got. So over to you, Aman, to talk about the land and buildings transaction tax in Scotland. Thank you.
So in this section, we will be discussing the devolved taxes. So what does devolved taxes means? So it is like delegation of powers to regional parliaments, Scottish Parliament, Wales Parliament, to tax some of the its transaction happening in their region for their own revenue and for the management of their local infrastructure. So the first one to discuss is lands and building transaction tax. In short, we can say is LBTT, and it is levied on the purchase of land and building, specified lands and building in the Scotland. So it is a regional tax first of all. यूके में इसकी एप्लीकेबिलिटी नहीं है, ऑल ओवर यूके नहीं है. ब्रिटेन में अगर आप प्रॉपर्टी परचेज करेंगे तो एलबीटीटी आपके ऊपर एप्लीकेबल नहीं होगा. वेल्स में करेंगे तो नहीं होगा. इट इज ओनली फॉर द परचेज ऑफ प्रॉपर्टी इन स्कॉटलैंड. ओके, so first is LBTT. It is a slab rate tax system. So a single transaction have a different rates for specified limits, and we will discuss this in detail through a help of example. So to determine that, in UK the slab system is also called as slice system, marginal slice, and in India it is called slab system, but in UK it is called slice system, and slab system is like a one-time transaction tax. So it is opposite of what we are discussing in India. Another tax is ADS tax, additional dwelling supplement tax. It is to discourage the holding of many properties, and once you purchase the another property, flat 8% is taxed on total purchase price. So we will discuss this also with the help of example, how LBT is calculated, how ADS is calculated, and how these two taxes work in sync. So for 20 from 26-27, the LBT rates and ADS rates have changed, and separate rates are applicable on residential as well as non-residential transactions. So coming to the next slide, we will discuss the calculation of LBTT. Okay, so this is the LBTT on second home. As I mentioned earlier that ADS is applicable only on purchase of second property. So for example, a buyer purchases a second home in Edinburgh for 400,000 euros in 26-27. So we have to compute the LBTT as well as ADS on the transaction. So first 145,000 are not taxable. Similar in same manner, total tax payable on the 400,000 is 13,350,000 euros, and it is LBTT. The ADS, which is applicable only on second property, is flat 8% on whole 400,000, and it comes to 32,000. So total tax payable on the same transaction is 45,350 euros. अगर यहीं पे ये सिर्फ एक सिंगल प्रॉपर्टी होती एंड फर्स्ट प्रॉपर्टी होती, तो टैक्स पेयर को ये 32,000 एडिशनल नहीं देना पड़ता, एंड द टोटल टैक्स पेबल विल बी 13,350. So this is the example to discuss LBTT and ADS, and I hope with the help of this example ADS and LBTT calculations are simplified. Coming to the next slide. Another devolved tax is landfill tax. So landfill is an area where waste is disposed, and in India, we do not have concept of landfill tax. So, but Scotland there is concept of landfill tax, and waste disposal is costly. So it is 130 euros per ton. It is based on the volume of the waste, and there are two types of rate. First is higher rate, which is also a standard rate, and another is lower rate, which is on specific materials. So the higher rate, the amount of taxes is reflecting the harm to the nature. So those materials which are less harmful to the nature are taxed at lower rates, and the lower rate covers mainly biodegradable waste, which easily devolve in nature and does not have any long-term harmful effect on nature, like soil, stones, ceramics, glass, and it is taxed at 8.65 euro per ton. The higher rate is 130 euros per ton, and it is levied on harmful waste like chemical waste, plastic waste, and another types of harmful waste which do not decompose easily in the nature. So this is all about Scotland devolved taxes, and these taxes are local taxes, and it does not fall in the administration of HMRC. It is administered by Revenue Scotland. I think this is the end of this section, and with this we summarize the section.
Hmm. So this was very, very important actually, the devolved taxes. So devolved taxes we discussed into two parts. One is the income tax. Yeah. So Scotland has one income tax, which they have defined the bands, six bands, different slabs, but which again is controlled by HMRC and they get only their share. Second is the taxes on land and building and the taxes on the landfills, which are local revenue for them. That doesn't, any part doesn't go to UK, and therefore these two devolved taxes become very, very important in Scotland. So when we were in Scotland, I was there for a few weeks. Hardly you will find any, you will find, of course, but very limited CPAs and chartered accountants there because most of them are based out of UK. Because there's nothing much in Scotland that you know could generate work. So these two, that is on purchase of land and building, like we pay stamp duty of 6 to 7% on the gross value. Similarly, they have this additional 8% payment, which is paid in case you buy a second property. Of course, for registration, there are charges always, but the significant amount. So it's a standard rate of 8%. In India, we have 5, 6, 7%, but there in Scotland, it is 8% stake, as in when you buy the second property. And land is actually a scarce commodity in Scotland as well. Second, on the wastage, as Aman rightly pointed out, the high rate of 130 plus euros per ton is on the waste, which could harm the nature. And this actually has gone down. Earlier, it was 400 euros per ton. But now, I think effective 1st April of 2025, it has come down to 130 plus. And the lowest rate, something for which is recyclable, the rate is 8 euros, 8 plus euros, which earlier was more than 15 euros. So that way, Scotland, as they are growing, they are also fine tuning all these things. So this was more on the devolved taxes. And now let's take up the India UK dimension. First of all, I'll give Aman to speak, and then maybe I'll also be adding the DTAA aspect under this section. So, Aman, if you could.
In this section, we will be covering the recent updates in the India UK. So last year, after Trump came into power, there were many taxes on many countries, import duties and everything. So to cater this problem, most of the nations came into bilateral agreements between them, and one of those agreements with India was India UK Comprehensive Agreement. It was the negotiation completed in 2025 last year, and it came into the force in 2026, few days ago, in 15 July 2026. So the key highlights of this agreement is to increase the bilateral trade, and the target for that is 56 billion, and it affects more than 137 sectors across India, and the main benefit we will be covering is from the perspective of Indian businesses and professionals. The first key highlight is double contribution convention. So earlier, what used to happen is, suppose if an Indian company has an employee and it is seconded to UK, then Indian company has to pay social security benefits here because it legally binding to Indian employers. And similarly, social security benefits in UK were also applicable on Indian companies. So there was double contribution in both the countries for the same employee. But coming because of this convention, the this double convention has stopped, and now Indian employers are not required to deposit social security benefits in UK. The another uh, key factor is that there is commitment by both countries to give a duty-free access for approximately 99% of India's export, which covers goods as well as services. Another key aspect is professional mobility. So before this agreement, there was a concept of economic needs test. So to give the visa access to a professional, the UK authority used to check whether there is economic need in the country, and if there are alternative options available domestically, locally. So if that economic need test does not fulfill, then a visa applicability was very difficult. But now coming because of this agreement, this economic need test is not required to fulfill, and professionals also include specific professionals mentioned in the agreement, which covers accountant professionals also. So those professionals are not required to fulfill that this economic needs test, and they can move freely between both the countries. Coming to next slide. Okay. So let us understand. So let us understand the concept of double contribution convention. So fact is, Mr. Iyer is employed by an Indian IT company and is seconded to UK site for 24 months for from 26 October, and he remains on Indian payroll and continues to contribute to Indian social security such as EPF, ESI, and others. So before 15 July 26, what so before 15 July 26, so before 15 July 26, what used to happen is the Indian company has to deposit in Indian social security schemes also, and in there is a UK national insurance, which was also liability of Indian employer to deposit on behalf of that Indian employee seconded to Indian. But with effect from 15 July 2026, this double contribution is not applicable. Mere certificate of coverage is to be obtained in India, and once it is obtained, the Indian employer is exempt from contributing in UK social security benefits. Okay. So the main point it not is that Indian employers are exempt to contribute in UK social security benefits, but it does not exempt the Indian employee on the incomes earned on services performed in UK. So it is exemption for Indian company for social security and not the exemption on income earned by foreign income earned by employee in UK. And this single concept has saved more than 4,000 crores of Indian businesses, and it is a very notable improvement in this series. So coming to next slide. The another major UK tax point is making tax digital. So it is a scheme implemented by HMRC to make UK taxation more digital and to move it on softwares rather than books and papers. So it is a scheme. It is a threshold based scheme. It is mandatory for persons having a specified threshold of income. For example, it is 50,000 euros for from April 2026, and in next phase it will be brought down to 30,000 euros, and then it will be brought down to 20,000 euros. So reduction of limit is to cover more and more assessees in this scheme, and HMRC has prescribed its own set of softwares, and to file income tax returns and to be tax compliant, the individual assessees are advised to use those softwares. Also, it is a prescribed, not a mandatory use of software, but there are certain criteria which need to have whatever software they are using, and those conditions have to be satisfied by those softwares. So software क्या क्या करने चाहिए? तो software must have record keeping and direct submission to HMRC through internet gateways and preparation of statutory accounts, filing of CT 600, SA 100, and VAT returns. All the software has to be compliant with these things, and most of the firms in UK follow a cloud bookkeeping platforms, and almost all those bookkeeping platforms are MTD compliant and certified by HMRC. This was about MTD scheme. In next slide, we will be discussing uh, the key difference between India and UK tax structure. Next slide, please. So this table is to summarize what is the difference between India and UK tax laws. First of all is administration. In India, we have finance ministry and UK has HM treasury. But to administer the tax laws, we have CBDT and CBIC. CBDT covers the direct tax aspect and CBIC covers the indirect tax aspect. But in UK, there is only one HMRC for central taxes and local revenue bodies for local taxes. Legislative structure is like in India, we have a single act for all types of income, for assessments also, for processing returns, for authorities, for administrative works. We have a separate act and separate rules. It is consolidated in one place. But in UK, there are multiple amendments, and of course, Finance Act also. Tax years is different in India for individuals. For in India, for individuals as well as for corporate, we follow financial year starting from 1st April to 31st March. But in UK, there are two separate tax years. For individuals, it is 6 to 5, and for corporate, it is 1st April to 31st March, similar to India. The another is residency of individuals. In India, the concept is majorly focused on physical presence in India. It is 182 days and 60 days, whatever the case may be. But in UK, there is statutory residence test, and these tests are detailed and very uh, comprehensive in itself. Basis of taxation is same in both countries, a little bit different. For example, India is taxing on RNOR and ROR basis, but UK is taxing either as a resident or not resident. So in India also, residents are taxed on global income, and the same is followed in UK also. Capital gains is covered in Income Tax Act only in India, and there is no separate act for it. Of course, there is separate rate, but that is also covered in the same act. But in India, but in UK, there is separate act for income capital gains, and capital gains rates are also mentioned in that act. So inheritance and estate tax in India, there is no concept of inheritance tax now. There was inheritance tax earlier, but it is not applicable right now. And in UK, there is still inheritance tax, and it is applied on transfer of capital from one person to another, or transfer of property as a gift or as a estate. Indirect taxes in India, it is covered by CBIC, and it is functioning on dual model, central taxes and state taxes. And in UK, it is VAT, and it is uniform all over the nation, and it is governed by HMRC only. Devolution of taxes. In India, we have concept of India is Federation of States. So we have in Constitution there are schedules where central taxes are mentioned and state taxes are mentioned. So some taxes are devolved to states like excise and on petroleum products and in liquors. And similarly, UK also have devolved taxes, and taxes are devolved to Scotland and Wales. Wales also have devolved taxes like landfill and land and building taxes. But for the simplicity, we have mentioned only Scotland, LBDT, and landfill taxes. But these are almost similar to Wales, but maybe the rates are different, but the concept is all overall same. So this is about the presentation. Over to Jay sir for uh,
Yeah. Thank you, Aman. Let's be on the key takeaways. But before coming to the key takeaways, Aman, I think you presented it very well. Let me summarize the section 6. What we have covered today is something which is very latest, starting from April 1, 2025, and in fact, April 1 of 2026 as well. Okay. So what actually has happened in last 1 year? That government of India has signed a trade agreement with uh, London in July of 2025, which actually came into force effective 15th July of 2026. And this was alongside the Double Contribution Convention on Social Security, which actually has saved nearly 4,000 crores, which is again a newspaper published figure. So earlier, if an employee is seconded to UK from by an Indian company, so Indian company was to contribute to the social security in UK, as well as because it is on the employees on their rolls, the provident fund contribution was also required to be made in India. So impacting the company, a kind of a double contribution. But effective July of this year, the agreement has been signed, and now India is only contributing to UK, and they are not contributing to the provident fund in India, which is a major savings. This is one. Number two, which again is very important, what we just discussed, that India, as of now, is showing a lot of progress in terms of the tariffs, in terms of the tax rates, in terms of reliefs and benefits that it gives as against UK. India is more liberal on certain fronts. Of course, on administrative fronts, we are still, India has to work a lot, but UK that way is very, very fast. Another very important point which we just discussed was digital. India already is digital. It is without any slabs. UK is so inspired by our digital, our UPIs, the payment online, the filing of tax returns for so long online, appearing everything digitally online on 26AS and so-called AIS, TIS. They have, but it is very limited digital. You still have to have the compilation done. India, maybe in next year, you will find everything on Form 26 AS with new name and Form 20 AIS with new name. So that way, India has done great. And as Aman just mentioned, 50,000, 30,000, 20,000 तक अगर आपकी इनकम है तो आपको डिजिटल होना ही है. Abhi bhi in UK you could file paper returns. In India, I don't think now we have any paper tax returns. Everything has gone digital. Even the tax assessment has gone digital. You do not know who the officer is. In UK, that situation is still not there. You know who the tax officers are. So these are some of the things, but some of the points that I think we need to remember. Number one, that the personal allowance or the standard deduction they call it, which is 12,570, it starts from 26, 27, and it will go up to 2030, 2031. So this is something very good. They don't do the changes very frequently as far as the deductions are concerned. And if somebody is earning euros 100,000 or above, then this standard deduction is not available. Similarly, the Scottish bans, which we just discussed, are applicable from the year of 26, 27, and they will go up to the year of 2030, 2031. Again, very, very interesting that every year you don't have to worry about the change in the bands or the rates. Another interesting aspect, as we mentioned, that Scottish and Welsh, they have reduced their landfill taxes from 400 to 130, from 15 to 8, 8.65. This again is fixed across certain period. So these are some of the interesting things which I think even as at India we need to learn. But overall, the key takeaways and the overall discussion that we have, one, that there is no single UK tax. We have to go through multiple acts. But the best part is that each act is comprehensive in itself. So if it is Employment and Pension Act of 2003, it will have the act, it will have the rules, it will have the procedures as well, except for the payment part. So comprehensive act. Second, what we learn that it is residency, the number of days which is important and not the citizenship. Okay. What is the other side of it? Okay, from a tax angle, one part, but the other side is okay, apart from getting the passport, in case you are a citizen, you do not get any other benefit if you are not resident. Unlike countries like USA and Canada, if you are citizen, you get certain benefits. So UK says no, residency is important from a tax perspective and from any other perspective. Not that a UK citizen sitting in India unemployed will get a employment allowance. No. So that way, this was about residency. Third, from April of 2025, both the challenges which arose, maybe because of USA, the new international position has been reset. UK has introduced the 4-year foreign income and gains regime. Okay, if a person has been non-resident for 10 consecutive years, next 4 years, any overseas income will not be taxable, which is very good actually, because earlier, again, it was not very decided. Fifth, as mentioned here, that Scotland sets the rates and bans for only non-savings, non-dividend incomes. So otherwise, the authority of collecting, administering, distributing is with the Highness of London. Okay, so these are some of the important key takeaway notes. And the purpose of today's session was just to have a brief background of how the UK tax law looks like. So today we were not onto any detailed or deep diving into any of the chapters. Okay, and I'm sure this is going to help us to at least broadly have the view of this UK taxation. And second thing, which I think I mentioned earlier, that of late, since 2025, the practice areas, particularly in London, for Indian chartered accountants has significantly increased. Because number one, as accepted by the world, not by us, we are actually intelligent. We could read all these acts together because this is how we have passed our exams. This is how we have been practicing in India. A thick book, but we know what is where and how it is to be practiced. And another and the last point, very important again, that from a payroll perspective, as the social security contributions have gone, a lot of people are not even aware. At least we should be educating our clients, if they have any UK connection. And in this regard, we are also practicing a summary note, which we are calling it as the black and white summary note for our background material, which I would be requesting Aman and team to share it with you as well for maybe discussing or educating the clients. So thank you everyone for your time and attention, and we'll be very happy to take up any question and answers on this. And also, I would like to thank Aman for giving such a
Beautiful.
beautiful presentation. Thank you, sir.
Yes, sir. I think it was very nice presentation from Aman, as well as Jay Kumar ji has supported on each of the chapter of the presentation, as well as in last he has given the key takeaways. And frankly speaking, for me this was the first session I have taken on. I have actually learned about the UK taxation, and what I found is really, so far as Tejwani has also summarized, so far as India is concerned, uh, uh, we as a practitioner deal with almost all the this entire act 1961 or now 2025. So all the topics, whether it is salary, capital gains, business incomes, we deal it with the entire Income Tax Act and all the topics which are covered therein. But at the same time, UK taxation, I found that there are multiple acts which are dealing with the taxation in UK. And listed by Tejwani ji, UK professionals are generally dealing with one act only. They are expert of the one act. Like suppose they are expert for the corporate taxation, so they are dealing with only that corporate taxation. They are not dealing with the capital gains. But since we have studied all these subjects uh, collectively, along with various other subjects too, that is indirect taxes and corporate law and various other laws. So probably our intellectual is really higher, which is again Tejwani ji has said that the world has also admitted about it. And friends, with this particular way of training which we had, now the UK taxation where they are going tax digital, where they are actually which we have already done, from the in the 1961 Act era as well as in 2025 era, everything is digital only. And not only this, in GST era also we are digital. So our experience of being digital may be a value addition for practicing at UK. So that is the second thing which I could observe from the entire presentation. And now this UK India trade agreement, FTA, foreign trade agreement. So this agreement wherein the chartered accountants or accountants are being given privilege to practice in UK arena, UK laws. So all these facts are actually indicating that as a chartered accountant, we can practice on UK taxation also, have our knowledge on this, and have multinational clients in this particular area. So I think a very good webinar, knowledge session, which has been done by Tejwani ji, and of course Aman has prepared the entire presentation. So we are thankful to both of you, sir. And as a token, I request Tejwani ji to please give Aman a book also. And thereafter we will have a yes, psychology of, yes, the psychology of money. So basically, considering the subject, again, the title of the book is very, very relevant. So thank you very much, everyone. Now we can start with the quiz. I request the